So everyone, Michael Manatskanyan here, and today is going to be freaking sick. I'm going to provide you a masterclass on co-living and not just talking about why housing unaffordability is making the co-living or rent by the room strategy more and more popular, what kind of the current market share looks like for the co-living strategy and how it's expected to grow. But I'm also going to be giving you a massive inside track as to why myself and other super investors have decided to focus all in on co-living rental properties, especially acquiring them creatively financed. I'm going to show you the numbers behind it, how you're able to fast track your path to financial freedom, how you're able to build much more massive wealth more quickly with less properties through this strategy. So I am very excited to get you guys going. This is a mini co-living masterclass, as well as providing you way more information if you are interested in potentially partnering with me on a really cool project that I have going on right now. Essentially, there's like 10 of us right now, and we're looking for a few more partners that want to invest at least $25,000. And that will allow them to buy 3, 4, potentially 5 properties. All of us will own those properties together. But more importantly, all of our partners will actually be the ones deciding which properties that we buy. My team will be the one to get the investments, analyze them, bring them to you, and then we decide collectively, is this a deal that we want to own together or not? And your at least $25,000 investment gives you ownership to that entire portfolio of deals. It's really a cheat code when it comes to growing and scaling your own portfolio so that you can obviously grow towards financial freedom, which is going to require you to have solid experience and leverage that portfolio for your own capital raising. At one point, you're going to realize your own money is a big bottleneck and you cannot buy the portfolio that you need just through your own money. You could if you had a extremely high paying job, or you already started off with a lot of money, or you wanted to spend as much time as possible to get there, right? I didn't want any of those things. As a military guy, I did not have a bunch of extra capital, and nor did I have a ton of extra time. Additionally, I didn't want this thing to take me 30, 40 plus years. The combination of everything I'm doing now is why I've been able to achieve financial freedom so quickly and at such an early age. And really going to go into all that for you guys. Awesome. All right. So I've further enhanced this presentation to make it even more educational for you guys. I really want you to walk away with just a ton of information that you can implement in your own business and really understand why is it that I, Michael Manatskanyan, buy real estate the way that I do, and then why has it allowed me to get so much more results than the majority of people in the real estate investing space and in a much shorter time frame than virtually most people that I know, right? And this is like not just buying deals, right? It's, in my opinion, it's pretty easy to buy deals using other people's money. More importantly, it's buying great deals that provide solid returns for you and your partners. You always going to be perfect? No, of course not. However, the goal is to maximize the amount of deals that you do that are great deals and are greatly beneficial for you and your partners. So with that, very simple intro. Michael Manatskanyan. If you don't know who I am, my real estate business is Coast to Coast Vets, and my education, mentorship, that kind of business is Super Investors, where I help other real estate investors scale towards financial freedom. I'm an Army veteran, engineer by trade, a chemical engineer, and I retired from all of that in 2024, so last year, to go all in on real estate investing and to also help other investors. I started learning about real estate investing in 2018, but bought my first property in May of 2020. My wife and I bought a 2-unit, lived in one side, rented out the other one, and then did that one more time the next year. Since then, I've pretty much focused on the super investor strategy, creative financing, capital raising, and co-living to acquire over $22 million of real estate in right around 5 years. I own currently in over 12 states. I own co-living in California, Colorado, Georgia, Florida, North Carolina, Texas. I also own a lot of long-term rentals, mid-term rentals, short-term rentals, and some commercial rental properties in a variety of states throughout the country as well. A lot of it, the reason I've been able to scale so quickly, a big part is my ability to raise capital, but more importantly, it's not that I come from money, or I definitely do not. It's not that I have all these high income friends, or I'm from these like classes of wealth. Like that's the opposite of my entire journey. However, getting really good at finding deals, analyzing them well, presenting the information to people who are interested in partnering with you has allowed me to raise large amounts of capital to be able to build my portfolio. And yeah, you're going to get real inside track to that today. Additionally, I currently own over 70 rentals. I've done over 100 transactions where I'm basically finding deals for other buyers. So people who want deals, help find those deals and sometimes restructure them, make them better, and pretty much serve it up to them as a bird dog or, similar services. So with that, let's get into why have I, after all of this, especially over the last 3 years, why have I hyper focused on the co-living rental strategy? Co-living, very simply, take a single family house, take a property, and instead of renting it out to an individual, you can either rent it out by the room as is, or you can convert office spaces, living rooms, dining rooms, things like that into additional bedrooms. Typically, I'm finding 4-bed, 3-bath properties and turning them into 7 to 9-bed, 3-bath properties that are rented out by the room. This rental strategy is massively advantageous for real estate investors. I'll get into why it's beneficial for the economy and those that need affordable housing and all that. But I really want to focus. If you're watching this, you're an investor. You're spending your time and energy learning from me, learning through this presentation because you're an investor, right? And your goal, in my opinion, should be, if I want to get $10,000 or $20,000 a month, every single month for the rest of my life, how can I get there quickly and efficiently, right? Not some get rich quick scheme or whatever. That's not how investing works. But if the goal is, if you can get there in 3 years, 5 years, instead of 10 or 20 years, your goal should be to figure out how can you get there more quickly. That's basically what I've been able to do through my super strategy. The main component of that is the co-living rental strategy because it gets way higher cash flow. For every $100 I can get in a single long-term rental, I can get 1,000 up to 2,000 or more in a single co-living deal. I'm getting way more cash flow coming in each month, which means I need way less properties and to be doing this for a way shorter period of time to get that same $20,000 a month that I was seeking and have overcame up to this point. So the cash flow is huge because that is the financial freedom that you are looking for. That is what you're going to pay your expenses with and never have to work for someone else ever again, right? That's like the number one thing for people when it comes to financial freedom. Additionally, not only do you get way more cash flow through a single co-living property than you do any other strategy, because you're able to buy bigger and better properties in better markets, since co-living primarily works in major cities, you get more appreciation benefits. Your properties are in better locations, right? Better states, better cities. They are better properties. Those properties appreciate more quickly than small properties or small locations or bad locations, right? Like properties in Georgia, or obviously here's an extreme like California, increase in value way more quickly than they do in Missouri, right? So because you're buying bigger, better properties in better locations, you're able to have your properties appreciate more in value. What that means is they're worth more. What that means is that you have more equity. What that means is your net worth is growing. So when it comes time to sell or refinance, to pull out that equity, you're going to have a much larger amount you can pull out, whether it's through a sale or refinance, and it's building your net worth along that whole journey. On that same point, because these properties are bigger properties and they are worth more, not only are you getting more cash flow because the properties are worth more, your tenants are paying down a larger debt for you. You're getting the income on the property. The first thing that you should be doing is pay mortgage payment, whatever that is. Because the mortgage payment is larger, your tenants are paying down a larger amount of debt for you. Once again, similar to appreciation where your property is increasing in value, well, the biggest expense on a property, right? The thing is the loan. That loan is also getting paid down over time. Well, if it's a bigger loan, they're paying down a bigger amount of loan for you. Adding the spread is your equity. That's your net worth. That's what you get to tap into through a sale or refinance in the future. Your tenants are doing all that, and co-living makes this way more advantageous. Additionally, because you're buying larger properties and you're renovating them up front, right, to convert them to the co-living model, you also get way more tax benefits. Not only because it's a larger property, which you get tax benefits on, but because you're also doing these renovations and furnishings, which is also a tax deduction. Additionally, and I'll really break this down in the upcoming slides, you're helping solve the affordable housing crisis when there's literally no other solution out there right now. Like the other solution is people spend an insane amount of their hard-earned money, pay a huge percentage of that to go live in a single home, or they live in their car or they live in their streets. So like there is no great middle ground. That's what this rent by the room strategy allows for. Obviously, in theory, in a perfect world, everyone gets a house and the government pays for it, or I don't know, whatever the dream is for that, right? But that's not realistic. Like that's just not possible, unfortunately, at least the way our country is built, right? Just the way it is. We're at least helping solve this where no one else is, especially not the government. Bonus benefits that I'll talk about, because we are on the cutting edge of the co-living or rent by the room strategy, there is way less competition with other investors. And because there's less other investors looking at this, and because a lot of properties make sense for this, there's a lot more accessibility, right? For right now, you're able to go and get a bunch of deals more quickly and easily because it's less competitive and a lot of properties make sense for this. So that is allowing you to then go build your portfolio in a shorter time frame, get all of these awesome benefits more quickly, and be done with this freaking rat race, right? Like, it's not a rat race in the same sense as your job, but it's like, once you're done with that phase of your life, once you've accumulated your 10, 20, whatever properties you want, and you decide to move on, you can, right? So the goal is to just get there safely and effectively, but get there and then just enjoy the rest of your life. You can be a weirdo like me that likes to continue working. I work a fraction of the hours that I used to. I still get a ton of results, but I'm more efficient about what I'm doing. But the idea is, if you choose to never have to work again, you're able to do that. The goal should be, how can you get there quickly and effectively? And the more accessible it is, or the less people are competing with, just the easier it is to do that, especially right now, this exact moment. And because we're buying bigger, better properties and better locations, it's much easier to find those property service professionals. What that very simply means is, when you need property management, cleaners, handymen, contractors, all of that, it's a lot easier to find that in Atlanta, Georgia, than it is to find it in some tiny Missouri town, right? There's just more people available, more referrals, more investors, more people you can tap into to then get those services done for you, instead of you trying to have to figure it out in a tiny population. And I say all this because that's where long-term rentals thrive, in these smaller markets where properties are worth 50 to 80,000 and they rent for $800 to $1,000 a month. So you do all that work for this little property, you get way less appreciation, way less debt pay down, way less tax benefits, and you get like a tiny amount of cash flow, $100, maybe $200 if you're lucky. All that work for that, and then it's harder to own and manage that property because there's literally no service providers. It's a freaking nightmare. That's why people don't do real estate investing and scale to freedom a lot of times through long-term rentals, because you're talking about hundreds of properties just to have a decent amount of money coming in each and every month to live your life enjoyably. And you don't need $20,000. Some people need $5,000. Some people need $10,000. Shoot, if you had $1,000 extra dollars a month coming in every single month, would that be a benefit to you and your family? At the same time, you also have appreciation, debt pay down, and tax benefits happening at the same time, building your wealth. I think $1,000 every single month would be very advantageous to a lot of people today, immediately, right? But then you get to 5, 10, 20, whatever your goal is, you can work towards that. So the super investor cheat code, right? It's combining not just the co-living strategy that gets you higher overall returns and cash flow, builds your wealth faster, and is more accessible, but it's combining that with creatively financed investments. That further makes it so that I have even less competition, right? The person that is looking to buy properties on market traditionally is very different than me when I'm buying creatively. I get way better terms. I get to buy those deals with way lower entry costs, meaning I get much higher returns, much higher cash on cash return, AKA how hard is my investment working for me? I get to buy way more deals with that. If it's $100,000, if I have 100K and I have to put in 40K creatively or 100 traditionally, I can buy 2.5 times the number of creatively financed deals that I could traditional deals, right? I also get to increase my cash flow because my interest rates are lower on creatively financed deals. Some of my seller finance investments are 0% interest rates. Some of them are 2, 3, 4, 5, 6%, because that's lower than the market average of 7, 8% for investment loans. I also get way more cash flow because I'm spending less money on paying interest on my loans. That means more returns means I get to achieve my goals more quickly, right? So I get to buy more properties and they perform better for me, which means I can buy even more deals because more deals make more sense creatively than they do at a 7 or 8% interest rate. Additionally, because I'm going creatively financed instead of through new lenders, it's massive because I eliminate the bottleneck of traditional financing. I don't have to submit all the same paperwork and get all these things vetted and tax returns and prove all these things to some guy who's sitting there and takes weeks to provide the underwriting and then challenges that. I don't have to deal with any of that. I could just go buy a property like that anytime I choose to. Means, once again, I can buy more properties more quickly. And because I have lower rates, once again, lower interest rates, my tenants are paying down my debts even faster, right? Lower interest rates on a loan means you're paying more towards principal, less wasted on interest, means your debt is getting paid down faster, adding to your overall ownership benefits. So combining creatively finance with co-living is literally the super investor cheat code. If you take it to the next level, the way that I do and I teach other people to do, then you're raising money to buy these deals, right? And that allows you to then buy as many as you freaking want, right? As many as, let me caveat that, as many as you freaking want, but don't waste your time and energy buying bad deals. because you're setting everyone up for failure, right? So buy great deals using other people's money. Everyone wins in those scenarios. So you can buy as many great deals as you want when you combine it with capital raising. To show you some numbers, I literally just threw this together a minute before this, but just to show you simply, that's what the formatting looks like, crap. But if I'm buying a property traditionally, the normal way someone would with a DSCR loan, buying the same $400,000 property, I'm putting 25% down payment. Most DSCR loans are 20 to 30% down payment. So $100,000 to buy that deal, average rate 7.5%. My mortgage payment is $2,097.64 for that $400,000 loan. Because I'm paying more towards the loan, all the income, all the expenses outside of that, I kept the exact same. Because the loan amount is higher and the down payment is higher, one thing to note is my loan is lower, right? My loan amount is lower because I'm paying more of that up front, right? $400,000 purchase, $100,000 down payment, $300,000 loan at 7.5% interest rate is almost $2,100 a month loan payment. That allows me to get a cash flow year one of around $14,000, which is still really high, right? Because it's a co-living rental, and an 8.2% cash on cash return. So even though my loan amount is lower because the interest rate is higher, my cash flow is lower than it would have been creatively, which we'll get into shortly. Additionally, because my entry cost is higher, my cash on cash return, how hard is my money working for me, is lower than creatively. It's almost like twofold. On top of that, the appreciation is exact same. Same property, same market, properties increasing in value the same, but my debt pay down is massively different. In this instance, it says $10,860. This one says $8,844. There might be an error here. I apologize. It's something I should have fixed before. I think it's only accounting for the sub 2 loan, not the seller finance loan at 3%. Regardless, I'm telling you, as a matter of fact, your debt pay down is directly proportional to your interest rate. If your interest rate is higher, you're paying your debts down more slowly, right? More is getting paid towards interest instead of paying down your debt. The lower your interest rates, the faster you are paying down your debts because you're wasting less on interest, right? So then the total return on investment, nonetheless, even in this scenario, is much better for the creatively financed property than the traditionally financed property. With all that, let's talk about co-living, right? We talked about the numbers. Why is co-living so great as a rental strategy for an investor? When you combine that with creatively financed investments, it gets even better, and showed you some numbers behind it. Let's talk about co-living, and why is co-living so important right now? Why is the rent by the room strategy so important right now? Well, housing is extremely unaffordable for the majority of people out there. Simply, housing prices and interest rates have gone up so much, including rental costs, but people's wages have not gone up very much. What that translates to is people who make less than $75,000 a year are paying a large amount of their monthly income towards rent, a large amount of their monthly income towards rent. And that is only going to get worse, because if interest rates do come down a little bit, which they might a little bit, housing prices will continue to increase in value massively like they did in early 2020, right? Like if it becomes easier to buy properties because interest rates are lower, housing prices go up because that is an asset that people want to buy now, right? It makes sense to buy them because there's more demand, prices will go up. That's great for people like me who own a lot of real estate. It's a lot worse for people who want to buy a property to live in, people who are trying to rent properties that, someone bought a property and is renting it out, but someone's trying to rent it. Well, they have to charge more for it. And for people who are just starting to get into investments. With all that being said, housing is unaffordable. There's really nothing that's showing it's going to get any better. It's only going to get worse as wages continue to stay fairly stagnant, just barely increasing. And everything around us is increasing in value. Housing prices, interest rates may be flat, may go down a little bit, but inflation is just eating up your dollar all the time. And the last couple of years have been insane. It's still really high. It's still several percent of inflation. With that being said, co-living is one of those core solutions, at least for providing affordable housing with the way that is logical, right? Like I said, in a perfect world, we have a magic wand and the government fairy gives everyone a house and everyone lives nice and has housing, right? But that's not realistic, not in today's day and age. So what can happen is investors realize very quickly, this is a great investment strategy. I'm going to do this. And they're going to provide more of these affordable housing rentals. Because people are in massive demand for lower cost housing, instead of spending 30 plus, 50 plus % sometimes of their paycheck on housing, people are spending like 30 to 50 or more % of their monthly paycheck on housing. That then paying for a car to get to work and insurance and healthcare and food, 100% of their paycheck is gone, or they're getting into debt worse and worse debt every single month just to barely make ends meet. People have said, okay, enough. I'm done with that. Like, they need a place to live because they really don't want to live on the streets. So what is the alternative? The rent by the room strategy allows them to rent a place for a 30 to 40% discount, utilities included, all that stuff. They get their own nice private room in a great location. Maybe they have to, or they have to share the kitchen or whatever. More often than not, they're not even using it anyway. But they get to save that extra money and either enjoy their life with it, go travel, go eat out, buy better groceries, order takeout. I said travel, just go do fun things with that money or save and invest that for their future, realizing that they would much rather do that, especially with the younger generation. With that being said, the market size for the co-living strategy is already almost $8 billion as of 2024. That is a very large market size. But more importantly than it being a large market size is the compounded annual growth rate is 13.5%. That's year over year growth, 13.5% every year. It's compounding for the next 5 years. What that means is it's going to double in the next 5 years, right? That's why I'm saying compounded annual growth rate, which is huge. There's literally no other rental strategy growing nearly, not even close to this rate, let alone a fraction of this rate. They're like short-term rentals and all that. They're actually flat, if not declining. Long-term rentals, yeah, they continue to grow, but just such at a steady pace. Co-living, because of its accessibility and the awesome returns for investors and the extreme demand from renters, it's going to continue to grow and will continue to grow. But once it gets too big, just like any rental strategy, just like short-term rentals made a lot of sense early and then don't make a lot of sense now, you don't want to come into this thing later than you have to. If you have the opportunity right now, talking to you guys, people who are watching this 5-10 years from now, hopefully it's still good for you, right? But people who can lock in now and take advantage of this situation and really provide this housing and get significant returns as a reward for it, like this is your real opportunity to really change your entire financial trajectory over the next 1 to 5 years, right? And then the people that get in early always benefit from all the long-term benefits as well. People who bought short-term rentals in 2018, 19, 2020, 2021, they still have really great performing short-term rentals. Those that bought later, not so much. So the combination of limited rentals, cost increases, and the shifting in spending habits is resulting in a massive growth of the co-living strategy. And it's already a pretty large market size, but it's going to double in 5 years. Absurd. And like as I mentioned previously, I went into much more detail. We have massive advantages as early investors. We get to buy these larger properties in better markets, leading to more wealth benefits for us. Appreciation, the debt pay down, and the tax benefits are all increased through the co-living model. On top of that, because we're also getting much higher cash flow and we get to stack a lot more properties because there's less competition right now, we are able to achieve our financial freedom way more quickly and efficiently with less properties than if you go long-term rental or really just competing with really with the long-term rental strategy. Combine that with creative financing the way that I do, then it's like the ultimate cheat code. Simply, supply is tight and demand is strong for housing. Costs are up for everything. Wages are stagnant for people who are getting income. And policy is so broken that, like government policy is so broken that they cannot solve these problems. However, they are making the co-living rental strategy much easier for people because they know this is a solution to something they cannot solve. And just building more high-end houses or $500,000+ houses is not going to solve what is needed for those that are making $15,000 to $75,000 a year. Building more single-family homes worth $300,000, $400,000, $500,000 is not going to solve this for them. They can't afford it anyway. Interest rates will only make it worse, and prices will continue to increase in value. So building is not the solution. It's more affordable housing, ideally from existing structures. All right, so let me talk about this really awesome opportunity that I have right now, which is the co-living buy box capital raise. What this means is for those who have at least $25,000, we can invest together and go and buy several co-living properties all at once. Every $125,000 that we've raised, we've just surpassed over $400,000, leads to another property, another co-living rental we get to buy together, right? And it's going to be properties that are creatively financed, co-living in major markets that have really solid returns. These are properties that have no less than 15% cash on cash return and a total return on investment of 30%. So we're only buying great deals in great markets, all co-living, and we're leveraging creative financing to make the returns way better. And the cool part about this time, the one and only time I'm ever offering something like this, is not only do we get to own multiple properties together, more importantly, the people who are my partners on this deal, they're actually decision makers. So it's not just, hey, I have this deal, we're going to buy it together. Let's raise money for it, right? It's, hey, I have these deals. Which, after we look at the analysis, which of these deals do we want to buy together? They get voting rights. You get to vote. You get to see the analysis, where the deal came from, the analysis, and decide, is this one that we want to co-own together? You got to be part of that entire process. And not only that, because you're an owner of the property, right? The capital partners will receive 45% of total ownership of the entire portfolio of currently 3, about to be 4 properties. Maybe we'll hit 5 or 6 properties by the time it's all said and done. You will get not only the 45% ownership and cash flow, the voting power to be a decision maker, and solid returns on your investment, but you get a massive credibility boost. As an owner of these properties and getting real world experience of these assets and having the co-ownership, you get to leverage that for your own ability to get more deals, understand how to better structure them, leverage creative financing, maximize your co-living operations, and to be able to raise money for your own investments, right? As I mentioned early on, your own money will always be your bottleneck in your investing journey. It's going to cost you $100,000 to $150,000 to get into your next co-living investment. This $25,000 investment, which is the minimum amount, you can obviously put in more if you want a larger ownership percentage, but that minimum investment amount will get you co-ownership of 4+ co-living properties, giving you the experience and the credibility of your own portfolio so that you can go and raise money from others to then go and buy your own investments as well, right? Like there's literally nothing else like this. The reason why this is the first and last that I'm doing like this is because honestly, it's too time intensive. I don't know how else to say it. It's a lot easier for me to go and raise money the way that I primarily do, which is, hey, capital partner with $100,000+. You bring this money, I got the deal. Let's buy it. My team will handle everything, as opposed to me involving capital partners in smaller increments, which is already more work, and saying, hey, you guys get to be voters of this and learn throughout the process. That is all more work, takes more of my time. It's not really worth it in the long term to do this over and over again. That's why this is my first and last opportunity of doing this, and the doors are closing. August 19th is the last day to get in on this. However much money we raise is the amount of properties we will all collectively own together, right? Those who invest, this the amount of properties we'll own together. I mentioned we just surpassed, we're past 3 properties. We're low 4s. We'll be at maybe 450 shortly. So that'll be close to 4. And then we'll get right to that 4. And if we get more, we get more. Everyone gets to co-own more investments. So additionally, if you are a co-owner already, you've already submitted and you want to invest in this, share it with people that you also think might be interested, because then that means more properties we all get to collectively own together. The ultimate goal, let's say you raise $1 million, that's where I'll absolutely cap it out, is going to be 8 total properties that we all get to co-own. Translates to approximately a $3+ million portfolio, 64 co-living rooms. At the end of the 5-year mark, we're going to hold these properties for 5 years. Each property will individually evaluate, do we as owners want to keep these properties as is? Do we want to refinance and pull some money out and keep the asset, or just sell it and just capture our equity, right? Capture that net worth, that equity I was telling you about. We want to capture that right away and everyone gets paid back and we all got some cool cash flow along the way. So property by property, we'll decide what do we want to do at the end of the 5-year mark. The reason why we're a solid team to work with, I mean, you could really read this for yourself, but I am phenomenal at sourcing deals and analyzing them and just presenting them in such a way that is really useful for those that are making an investment decisions. Those that want to potentially partner with us, giving them the information more straightforward is a massive advantage. You will learn that because you'll be part of that process as we are analyzing deals and presenting them. And there's no shortage of great creatively financed co-living opportunities that I can bring to us to decide to buy together. I have a really phenomenal asset manager who does all of my project management, Leanne, over 20 years of experience doing this kind of stuff. She manages all of our due diligence when we have it under contract, getting all of our quotes for insurance, for renovations, overseeing the renovations of the contractors, setting up the co-living properties, getting the furnishings, designing the layout. That's, again, like I said, overseeing the renovations, getting the furnishing set up, organizing with our local boots on the ground team. She hires and trains those guys as well as property management. And we leverage technology as well as local property management for the day-to-day operations and placing tenants. And we have a really awesome financial team between a CFO that I leverage fractionally, a bookkeeper, and a CPA, a tax guy. We have a really solid financial team, which you would also get information from. All right, so some potential risks. Every single investment strategy has a risk. Some of the key ones that I want to highlight: zoning and regulations. So many cities do not have very clear guidelines for room by room rentals. However, a lot of states and local municipalities and cities have been changing their laws to be more and more favorable to co-living. Or if they're not changing the laws, they're looking a blind eye to the things that would limit the ability for co-living to work. For example, one of them is occupancy laws. A lot of locations have laws that say, hey, if you have more than 6 people in the same house that are not part of the same family, like that's the limit of different non-familial people you can have in one house, right? A lot of places have stopped that, reversed that, or stopped caring about that as long as you're doing things the right way for the housing that you're providing. Additionally, we only operate in markets that are already favoring co-living or allow us to put in the 6, 7, 8, 9 tenants in that property. So we're just choosing markets that are more favorable. I'm not going to try to convince a state that doesn't want to do it or a city that doesn't want to do it that they should do it. I always go based on where there is demand and it's favorable for us to do so because that allows me to be more scalable. Why would I waste the time and energy trying to force something to work somewhere it doesn't when I can go buy 5 properties in a location that does with that same time and effort? It's illogical, right? Financing challenges. Well, a lot of lenders out there, if I was to go buy a property to use as co-living, they won't give me a loan based on the co-living income. They'll focus based on the long-term rental income. A lot of properties may be great co-living, but won't be great long-term rentals. The issue with that is they won't give you the loan to buy that. I don't care. I buy all my properties creatively financed. I don't deal with banks in that same way. Additionally, there are more lenders out there that do, like there's a few now, a handful, that do provide co-living income loans, like base loans, DSCR loans. And over the next 5 years, when it's time to refinance some of our loans, there's going to be even more of these as this becomes more and more popularized. As I mentioned, it's already large enough where there are lenders offering it, but it's about to double the entire market share over the next 5 years if it doesn't grow even faster than that. Tenant quality control and management. So obviously we have more tenants on the property. There could be more operational management issues, right? More turnover, more potential late payments, roommate conflicts, management headaches, all that crap. Well, luckily for you as a capital partner, you don't have to deal with that. If you're trying to do what I do, well, great. What you need to do is have very strong systems in place to ensure you're only getting the right people who make sense for your properties, have really effective management, leverage technology to as much as you possibly can to minimize those issues before they ever even happen, right? It's up to you as the owner to minimize that to the best of your ability. Does that mean everything will be perfect? Absolutely not, right? But having effective systems, management, and technology on your side allows you to minimize that and then address when things go wrong much more quickly. Additionally, this is a concern I've heard, which I think is somewhat illogical, but market saturation concerns. What if, like short-term rentals, there are too many in one location, right? Like, yeah, that is a concern for certain management strategies, but no one's really saying, well, what if there's too many long-term rentals in a market, right? It's not as much of a concern, primarily because there is such a high demand for this type of housing and there's such a shortage of it available. We are not going to even get close to crossing that path, especially those that are early adopters over the next 1 to 5 years, right? Like we're not even gonna get close to even meeting the current demand, and the demand will continue to increase as wages do not increase much and the economy continues to get worse and worse. In the sense of, I'm not saying we need an economic shutdown or whatever. If there are economic issues, it actually further drives the amount of people looking for lower cost housing, right? So it'd actually be an advantage for this strategy. But I'm saying just as the economy stays as is and just continues progressing with the percentage that wages are increasing is much lower than the way the cost of everything is going up, it'll only continue to get more and more in reality. Not only is demand way in excess of the current supply, but I believe, and the data basically shows that demand will continue to greatly outpace supply. That's just the reality of it. And diluted returns. For this very specific strategy, where we're pre-raising the money to then go buy the deals, the longer it takes to find deals, the less time our money is working in those investments. So the goal is to start immediately buying properties. Well, great. I'm used to buying 2 to 4 properties a month, right? I've slowed down at certain periods when it makes sense to not buy a bunch of properties at once. But if we have enough capital to buy 2 to 4 properties, we can get that done within the first month. Buy them, renovate them, furnish them, and get them operational within a month. We get to 5 to 8, will take us 2 months, maybe 3 months total. So it's not going to be much of a difference, especially compared to investing with some operators who are doing certain strategies that just take way longer. For example, building a new house takes a lot longer than it does to buy a property and renovate it. Or if you are less experienced with renovations or furnishings or getting your properties listed, well, that's several months of wasted time right there. We don't have those concerns. In this particular instance, we make up for all of that by having really great operations and systems and team members. For other investments, when it's like we have the money in the deal right away, well, that's a superpower that we have as well. It provides us a massive, we get things going and renovate it and rent it out as quickly as possible.